What's up, everybody? It's financial freedom. And look, I get it. 5% loans sound pretty freaking awesome right now. I mean, the stock market has historically returned around 10%, so borrowing at half that to invest seems like a no-brainer, right? Well, not so fast. While the math might look good on paper, there's a lot more to this equation than meets the eye. We're talking potential risks, hidden downsides, and the psychological factors that can make or break your portfolio. Would you take out a loan at 5% interest to invest in the stock market? Could it be the secret to massive wealth, or is it just a risky trap? In this video, we'll break down real market data, investment strategies, risk factors, and expert research to answer one critical question. Should you use leverage to invest for the long term? Let's dive in. Before we even touch the idea of borrowing money to invest, we need to talk about the fundamental principle that makes this whole conversation even remotely possible: the power of long-term investing. See, the stock market is a wild ride in the short term. It's like trying to predict which way a squirrel will jump next. Good luck with that. But over the long term, the stock market has consistently trended upwards. Let me give you an example. The S&P 500, which is like the all-star team of the 500 largest publicly traded US companies, has historically returned an average of around 10% per year. That's not some made-up number, guys. That's factoring in everything: the Great Depression, World War II, the dot-com bubble burst, the 2008 financial crisis, even the crazy year we had in 2020 with the pandemic. Through it all, the market has always bounced back and continued to climb higher. Now, I know what you're thinking. Past performance doesn't guarantee future results, right? And you're absolutely correct. But here's the thing. The underlying factors that drive long-term market growth haven't changed. Innovation, productivity, and a growing global economy, these are the engines that push the market forward, and they're not going away anytime soon. Now, let's talk about time. The longer you're invested, the more time your money has to grow, and the more you benefit from the magic of compound interest. Compound interest is like this snowball effect where your returns generate even more returns, and those returns generate even more returns, and so on. It's like a financial chain reaction that can turn small sums of money into substantial wealth over time. But here's the catch. Time is your best friend when it comes to investing. But it can also be your worst enemy if you're not careful. See, the stock market goes through cycles. We have bull markets where prices are going up, and we have bear markets where prices are going down. And sometimes those bear markets can last for a while. Now let's talk about this 5% loan situation. On the surface, it sounds pretty tempting, right? Borrow money at 5%, invest it in the market that historically returns 10%. Boom, you're pocketing a cool 5% profit, right? Well, hold your horses, Warren Buffett. It's not that simple. First of all, those are just averages. The market doesn't just hand you a neat 10% return every year like clockwork. Some years are better, some years are worse, and some years you might even lose money. So, let's break down the math a little further. If you borrow $10,000 at 5% interest, you're on the hook for $500 in interest payments every year. Now, if the market goes up by that magical 10%, you make $1,000 on your investment, subtract the $500 interest payment, and you're left with a $500 profit. Sweet. But what if the market only goes up by 5%? Well, now you're breaking even. You make $500 on your investment, but that gets eaten up entirely by your interest payment. And if the market goes down, well, now you're losing money on both ends. You're not only down on your investment, but you still have to make those interest payments, which just adds insult to injury. And remember, this is all assuming you're only borrowing that 5% once. In reality, if you're using margin, you're essentially borrowing money on a rolling basis, and those interest charges can add up fast, especially if the market isn't cooperating. Plus, there's always the risk of a margin call. That's when your broker forces you to sell your investments to cover your losses if your account value drops below a certain level. And trust me, you don't want to be in a situation where you're forced to sell your investments at a loss just to cover a margin call. Alright, so we've talked about the math of borrowing at 5%, and it's not as simple as it seems, right? But here's the thing, the real dangers of using leverage, especially when it comes to investing, run much deeper than just the numbers. We're talking about the psychological impact, the hidden risks that can sneak up on you, and the potential consequences that can derail your entire financial future. First off, let's address the elephant in the room: debt. Borrowing money to invest, even at a seemingly low rate like 5%, puts you in a position of debt. And debt has a funny way of weighing on your mind. It can create stress, anxiety, and even lead to poor financial decisions down the road. When you're investing with your own money, you're playing with house money. But when you're using borrowed funds, the stakes are higher and the pressure can be immense. But here's the real kicker. Borrowing to invest can amplify your losses. Remember how I said the market doesn't just go up in a straight line? Well, when you use leverage, those downturns can be absolutely brutal. Let's say the market drops 20%. If you're invested with your own money, you're down 20%, which sucks, but it's not the end of the world. But if you borrowed money to invest, you're not only down 20% on your initial investment, but you also still owe that money, plus interest. That can turn a manageable dip in the market into a financial nightmare. And don't even get me started on the psychological impact of losing money that you borrowed. It can be devastating, leading to panic selling, poor decision-making, and a complete loss of confidence in your investment strategy. Trust me, I've seen it happen firsthand, and it's not pretty. Okay, so by now, you're probably thinking, is borrowing money to invest always a bad idea? And the answer is, it depends. There are actually smart ways to use leverage, even in the world of investing, but it requires a very specific set of circumstances, a whole lot of discipline, and a rock-solid understanding of the risks involved. So if you're absolutely dead set on using leverage for your investments, here are my 5 golden rules to do it as safely as possible. Rule number 1, never invest with money you can't afford to lose. This goes for any investment, but it's especially crucial when you're using leverage. Because if things go south, you need to be able to handle those losses without derailing your entire financial life. Rule number 2, have a solid financial foundation. That means having a fully funded emergency fund, no high-interest debt, and a clear understanding of your income, expenses, and budget. Don't even think about using leverage if your financial house isn't in order. Rule number 3, start small and scale gradually. Don't go all in on margin loans right off the bat. Start with a small amount that you're comfortable with and slowly increase your leverage over time as you gain experience and confidence. Rule number 4, have an exit strategy. Know exactly when you're going to reduce or eliminate your leverage, whether it's based on a certain market return, a specific time horizon, or a change in your financial situation. Having an exit strategy can help you avoid making emotional decisions in the heat of the moment. And finally, rule number 5, seek professional advice. Before you even consider using leverage, talk to a qualified financial advisor who can assess your individual circumstances, risk tolerance, and investment goals. They can help you determine if leverage is right for you and guide you towards the most appropriate strategies. Alright, let's wrap this up. We've covered a lot of ground today, from the power of long-term investing to the dangers of leverage and everything in between. So the million-dollar question is, should you borrow at 5% to invest? Well, as I said before, it depends. There's no one-size-fits-all answer here. It all comes down to your individual financial situation, risk tolerance, and investment goals. If you're someone who's just starting out with investing, has a lot of debt, or isn't comfortable with taking on significant risk, then no, borrowing at 5% to invest is probably not the right move for you. Focus on building a solid financial foundation first, paying off any high-interest debt, and investing in low-cost index funds within a tax-advantaged account like a 401k or Roth IRA. But if you're an experienced investor with a high-risk tolerance, a solid financial foundation, and a long-term investment horizon, then using leverage strategically might be an option worth considering. But remember, even if you check all those boxes, it's crucial to proceed with extreme caution, follow the 5 golden rules we discussed earlier, and constantly monitor your investments and risk exposure. Look, the bottom line is this. Investing is a marathon, not a sprint. It's about making smart, informed decisions that align with your financial goals, and that includes understanding the risks and potential rewards of using leverage. Don't fall for get-rich-quick schemes or let the allure of easy money cloud your judgment. Remember, the most important investment you can make is in yourself, your financial education, your long-term planning, and your ability to make sound decisions that will set you up for success. So there you have it, guys. Borrowing at 5% to invest might seem tempting, but as you can see, it's not a decision to be taken lightly. There are potential rewards, sure, but the risks are very real, and the consequences of making a mistake can be severe. Remember, investing is about building wealth slowly and steadily over time, not chasing quick profits or taking unnecessary risks. What do you think? Would you borrow at 5% to invest? Let us know in the comments, and don't forget to like, subscribe, and hit the bell icon for more finance insights.